But before I came on stage, I had the privilege of sitting in the Speaker's Lounge listening to the Chancellor's remarks with an eminent economist. So he's going to now come up on stage and give us his take on those two Bs and maybe that ERC. Ladies and gentlemen, Gerard Lyons.
Good afternoon. It's a great pleasure to be here. Thank you for inviting me back to speak to this conference. I spoke at it a number of years ago, so it's great to be back here and in Edinburgh. I'm going to speak about the budget in a moment. Today we've had a very welcome and I would say necessary huge stimulus to the UK economy. This morning with the Bank of England with monetary and prudential policy combining to cut rates, provide a term funding scheme for small firms, and a cut in the counter-cyclical capital buffer, slight mouthful that, which should add potentially 190 billion, if the banks took full advantage of it, to potential lending in the economy. And then we've just had the budget, which has announced a huge fiscal boost, focused on the spending side. Just looking at one of the devils in the detail as I walked up the stairs, there's a small tweak in taxes. Taxes are set to rise over the next few years. But overall, it's a huge stimulus. Now, before I focus on the budget, I've been asked to talk about the virus and the global economy. So I'm going to do three things. First, comment on the virus and the economic implications. Second, focus on the global context in which we need to judge the UK. Then third and finally, the policy environment here in the UK and what it means for growth and indeed for all of us here in this room. But let's begin with the virus. Recession, slump, or recovery? What will be the economic consequence of the coronavirus? It's not yet clear. In fact, maybe this afternoon the two words that really should dominate our thinking are uncertainty and unorthodox. Uncertainty in terms of where the virus will take us, and unorthodox in terms of the policy responses, not just here in Britain, but globally. The situation we are facing is very challenging, and analogies have been drawn with 2008. And I think it's right to draw analogies with then. Then it was a global financial crisis, now it's a global health crisis. In 2008, we had to be over the worst in terms of the financial sector, although you could argue it's still sorting itself out 12 years later. We had to be over the worst for people then to become confident that the economy would be past the worst. And likewise now, it's difficult to become too confident about the economy until we're clear we're past the worst in terms of the health issue. Therefore, we need to focus on that aspect. But there is also a very clear similarity with 2008 in that there is a significant economic impact, and that policy needs to play a part. In 2008-09, the financial crisis led to a recession. But were it not for the policy response, it would have been a depression, far worse. Policy did work, but we still had a recession. This time, the question, and that comes back to that issue about whether it's a recession, a slump, or a recovery, policy needs to play its role. It looks likely that there will be a recession at a global level, but that policy, if it's anything like we've seen today in the UK across the rest of the world, it will avoid anything worse, subject, of course, to the health conditions turning around. Obviously, I'm not going to focus on the epidemiology, but on the economic and financial aspects and the policy side. Now, no one was expecting this crisis, but it's important to say that in the past, we have had times when there have been concerns about whether the world would be hit by a pandemic. Each year, there's many different assessments of the risks that we face. And the World Economic Forum, for instance, every January produces a detailed assessment based on feedback from risk analysts, etc., across the globe. The top 5 risks this year all seem to be climate change related. In recent years, it's been climate, it's been linked to the financial sector, and it's also been linked to populism when one looks at all the risks. The last time a pandemic figured in the top 5 was back in 2008. And at that time, pandemics and chronic diseases were at the centre of attention. So there has been a lot of work that's been carried out on pandemics. And the key issue is that while most things have a normal distribution, what one needs to avoid with a pandemic is the fat tail risk. That is, if you can't contain and control it, you then get into a situation of what's called a fat tail risk, a small probability, high impact event. And the reason why the markets are panicking at the moment is partly because they fear that we could be going into that territory. Now, we have a vaccine gap at the moment, which means that the issue is going to be with us for some time. But we have had similar shocks, albeit not all the same, in recent years. SARS in 2003, and I remember being heavily involved in sort of addressing that when I was head of research on the global markets management team at Standard Chartered. That hit Northeast Asia, Hong Kong very hard. But what was very evident then was that the role banks played and the role that policy played did play a significant part in leading to the turnaround and recovery. And that's a lesson maybe for today. Ebola in 2014, and of course the influenza pandemic or the H1N1 in 2009. Initially, the important thing is that these are supply-side shocks. But as they tend to take hold, they then become a demand-side shock as well, hitting spending, hitting confidence, hitting trade, and delaying investment plans. Now, all of these previous crises tend, while they are different, tend to have a similar economic impact. The economic impact tends to be seen the most in the first and second quarter after the shock. And then there tends to be a quick recovery, often helped by policy, although sometimes it takes a long time for policy to feed through. So when one looks at the lesson the previous similar shocks, if one can say they're similar, they've tended to be V-shape, the recovery. And indeed, that's underlying some of the thinking in the West at the moment. But the challenge, of course, is that if one looked at the world economy at the beginning of this year, China and Asia combined were expected to account for 2/3 of the increase in global growth this year. And what we've seen is that because of this virus, China has been at a standstill in January and February, and supply chains across Asia have been impacted. Some economies, Taiwan, South Korea, Singapore, maybe even Hong Kong, have done relatively well, largely because of the impact of SARS and the lessons they learnt. But nonetheless, the economic impact has been severe and has clearly hit global growth. Now, if China is genuinely past the worst, as its policymakers tell us, then in Q2, the economy might start to recover. But we need to yet be convinced of that, and therefore it's premature to suggest that. But whatever happens in China naturally will impact global sentiment. But nonetheless, the standstill we've seen in China in January and February is now going to be repeated in Western Europe and maybe in the States as we move into Q2. Many people are worried because of Italy. There is a strong connection between Wuhan area and Milan in terms of textiles. In fact, last decade, the number of Chinese manufacturers of textiles in that Milan area has outnumbered Italian textile manufacturers. So when, obviously we don't know what caused the virus to take off so much there, but that connection with China is quite significant, and maybe that could be an explanatory factor. But nonetheless, we don't know, and therefore there is a genuine fear that what was seen in Italy could be replicated elsewhere. So when one looks at it, the fear is that we will have not just the slowdown in China, but in the best case scenario, a standstill in Western economies through Q2. And then the second round impact starts to feed through into the third quarter, as spending put on hold in Q2 leads to investment being put on hold. So on the best case, one would say that it's not so much a V as we've seen in previous supply-side shocks. At best, it's more likely to be a U, with the global economy contracting in the second quarter and maybe the third quarter as well. The markets, however, fear it could be a slump, which is not a V or a U in terms of the economy, but more an L shape. For that to materialize, one would have to expect the health issues to not turn around in China, as the authorities are suggesting, and the fear being that the health implications for the West would be worse than we're currently fearing. and in which case the economies would be even weaker, even with a policy response. So in terms of the virus, my feeling is that in answering the question, is it a recession, a U, a slump, an L, or a recovery, a V? While the lessons from previous such shocks is that it's a recovery. After 2 quarters, you tend to have a V-shaped rebound. We can never fully quantify the downward leg of the V, how long it will last, or indeed how deep it will be. But on the best case, it's more likely to be a U, where weakness seen in Q1 is replicated in Q2 in other parts of the world, and also continues into the 3rd quarter. Before then, the policy response and hopefully other factors and the natural recovery leads to the world economy starting to recover before the end of the year. And that leads on to the second part, the world economy itself. When one judges the world economy and the outlook for the UK, there have been 2 big drivers over the last decade which are still likely to influence things the further ahead one looks. One has been the aftermath of that global financial crisis, which has led to low growth, low productivity, low wages, and low interest rates in Western economies. But within the West, the US has outperformed quite significantly the rest of the West. And the second factor, which may be because we've talked about it for so long, we tend to sort of think, oh, I've heard that before, and put it to the back of our minds, and that's the shift in the balance of power. It's still important and will be for decades to come. It's reflected not just in the growth of China, but of other so-called emerging economies. And that means that more of global growth will come from emerging economies. But if one's looking for a region in particular that will excel, it's a vast region stretching from India in the west to America in the east, the Indo-Pacific. So it's more than China, it's more than America, but it includes a vast area. So globally, it's America outperforms the rest of the West, but the rest of the world has outperformed the West. China and America are dominant, and hence how the virus impacts both of those will clearly be key. Now, in recent years, global markets have been caught out twice before the virus by what has happened to the global economy. This virus is the 3rd shock in the last 4.5 years. In 2016, the world economy proved far stronger than the markets were expecting. That led to a revision of expectations up, so much so that by the start of 2018, economists and markets were expecting the global economy to be very strong, and then they were caught out for the second time when the world economy weakened. That weakness continued through to last August, which is the last time that the markets were fearing a recession. Through 2018 and last year, 3 factors slowed the world economy. Monetary policy tightening led by America, tightening in China as they tried to offset the debt problem they feared, and also an escalation of trade dispute between America and China. By last August, 2 of those 3 factors had reversed. Interest rates were then falling, led by America. China was easing policy. As we moved into the beginning of this year, there was an easing of fears about the trade dispute. As a result, in January, the International Monetary Fund, a good barometer of global growth expectations, said that after 2.9% growth last year, they expected the world economy to grow 3.3% this year, 3.4% next. Up until about 2 or 3 weeks ago, expectations had been clipped by about 0.2 for those forecasts. But since then, particularly since the escalation of the virus in Italy, expectations have been cut. No one really can quantify the full impact. It's unlikely to be an outright recession in terms of growth falling below 0 globally as it did in 2009, but it will be a very weak picture. The OECD thinks it could be as weak as 1.5%. We don't know, but that maybe is a good guesstimate. Anything, to be frank, below 2.5% global growth is particularly weak. But maybe as policy recovers, we will then see like an elastic rebound as we move into 2021. Monetary policy has been the shock absorber for the last decade, but the challenge with monetary policy, being the shock absorber, is that when rates are low, even ahead of this last few weeks, Markets do not price properly for risk. And the world economy has been very vulnerable to shocks, as we've seen with how this virus has impacted. Monetary policy will still do some of the heavy lifting. Interest rates are going towards zero in more countries. Over 50 central banks have eased already this year. But now, fiscal policy is expected to do more of the heavy lifting. That's good, but therein lies a challenge. Last autumn, the latest proper global assessment of global debt figures showed that then global debt had risen to $253 trillion, a massive, massive, massive 322% of global GDP. We now have a situation of unorthodox monetary and fiscal policy, with even more being done given the crisis ahead. When you look ahead at the global picture, naturally the temptation and focus is always to look at the near term. But there are some important questions you need to be asking yourself about the longer term outlook, because they will impact not just the economic picture, but the shape of yield curves and interest rates, and indeed overall market performance. Strangely enough, they all come down to the Ds. I'm not going to talk about all of them now, but deflation, dollar, debt, as I've mentioned, demographics, the data digital revolution, and deglobalization. A few of these will come very much to the fore. The deflation issue will very much be more center stage in the next few months, particularly as oil prices have fallen sharply. Normally, a fall in oil prices is good news for the world economy. It sees a switch from producers of oil to consumers. Also, many of the major economies, say in Asia, are oil importers. But it also has challenges, as we've seen in terms of the US shale industry, in terms of credit markets, and also it reflects concerns about the underlying global economy. Last year, China accounted for 80% of the increase in global oil demand, and this year, according to the International Energy Agency, we're expected to see the first fall in global demand since 2009. That justifies yields being low and interest rates falling. But it also leads on to an issue about the dollar. The dollar is a very important transmission mechanism in terms of global shocks. But beneath the challenges between Russia and Saudi Arabia is this long-going issue about the role of the dollar in the future. I think for the moment, though, in the period of uncertainty, the dollar still retains much of its value. But the good news also at the moment is that the Chinese currency is stable, and the yen strengthening shows that when it's a case of looking for safe havens, it's not just the dollar, but some of the old traditional ones come to mind. The other D that will come more to the fore is deglobalization. The challenge with this is that globalization has led to low inflation. It seems strange, having talked about deflation, to ask whether we will see an inflation shock. But that might be the issue people start to focus on in 2 or 3 years' time. I don't think we will see an inflation shock, in part because I don't think we will see a full move to deglobalization. But the challenge is there between the politics in the West and the economics globally. Economics justifies globalization, but what we've seen as a result of this crisis is likely to challenge the just-in-time techniques. But to put it together at the end, despite everything, I would still be relatively positive about the global economy, largely because of what I call perspiration and inspiration. Perspiration is the changing demographics, which has wealthier, older people in the West, but young, dynamic markets in which to sell into across Africa, across large parts of Asia. The inspiration aspect, though, is particularly important. The fourth industrial revolution, the new technological change. I think these are still positives, but in the very near term, the uncertainty about the virus, the uncertainty about the shocks it's unfolding and it's delivering, naturally should make us cautious about the very near-term outlook. And that brings us on to the UK and how to look at the UK. The UK is a very imbalanced economy. And when one judges the budget, it's not just a case of talking about the levelling up that the Chancellor mentioned, but the imbalances are quite deep-rooted. As much as this government thinks it's the first to actually talk about levelling up, it's been an issue for the last 40 or 50 years. The question is execution of the policy. Today's budget should give us confidence that that execution might finally be delivered upon. But it's important to remind ourselves of how deep-rooted and widespread the current imbalances are. Place is an imbalance, but not just in terms of London versus the rest. It's also urban versus rural. It's also coastal versus inland. Some of the cold spots where your life chances are determined by where you are born, some of those cold spots are in coastal and rural areas. So it's not just about infrastructure spending in northern regions, it's also about the policy for fishing linked to the exit from the EU, and it's about the policy for farming too. Another big imbalance is skilled versus unskilled workers, which goes to the heart of our productivity problem. 43% of British workers work in unskilled sectors. Very important sector. In fact, it's strange the way we define some of these unskilled jobs. In the social sector, one would say the skills are very necessary. But nonetheless, low wage, low productivity is evident across big swathes of the economy. That links into education and into vocational training, which did receive a significant boost in the budget today. Then there's the challenge with houses that are owned versus those who rent. The big imbalance that needs to be addressed by a large increase in house building, which still will take some time. And then there's an imbalance between old and young. How do we address all this? The budget needs to be judged in the context of what I would call two sets of three. The first set of three is how leaving the EU impacts us. When one looks at leaving the EU, it's a case of not just our future relationship with the EU, which needs to be a sensible future relationship, but how that will impact our domestic agenda and our international agenda outside the EU. To make a success, we need to get our domestic agenda right, our relationship with the EU right, and our relationship with the rest of the world right. No mean task. But this will influence heavily the government's approach to leaving the EU. To make sure that it doesn't tie our hands on the domestic agenda, the government will insist that we leave the single market so it allows maximum freedom on taxes and regulation for the domestic economy. It will also insist, as it is, that we leave the customs union to allow the UK to be able to set trade deals with the rest of the world outside the EU. And as we've seen, it's put down its marker for that negotiation with the EU. I would think there will be a deal done, and I think that clearly some of the worries about the EU, while valid, many of them are overblown in terms of how the UK will leave. But nonetheless, that's a key factor. But the second set of three is a background to today's policy measures. And one could call this maybe three legs on the stool, where each leg needs to carry its weight, or if you want to be more illustrative, it's like Japan, three arrows that almost need to hit the bullseye. One arrow is monetary and financial policy. We need to have monetary and financial stability. Another arrow is fiscal policy, and the third arrow is the supply side agenda. This morning, we saw further evidence on the monetary and financial side. Interest rates, I think, need to remain low for some time. But the challenge, of course, once you get embedded with low rates, as Japan has shown us, is that the economy becomes overly dependent on low rates, and it becomes very difficult to escape. It requires that escape growth trajectory that was once talked about vividly, but no one seems to mention at the moment. But in terms of the financial policy, it's important to say, in my mind, that the regulatory pendulum, which was at one extreme before the 2008 financial crisis of too light, in my view, has gone to the other extreme of being too heavy. And therefore, what happens on the regulatory side is very important. Hence, the measures announced this morning on counter-cyclical capital buffers and one or two other measures are important. I think that is welcome and it's necessary, the changes we've seen this morning on monetary policy, microprudential policy and macroprudential policy. And then that leads on to the budget, fiscal policy and the supply side agenda. I'm sure many of you, if not all of you, heard the budget. The challenge about making an immediate comment on the budget is that often budgets that seem great a few minutes after the Chancellor have sat down, often a few weeks or months later start to unwind. Often the devil is in the detail, or more often than not, the economic projections that form a key part of the budget start to unwind, don't materialise, and the rest of the sums start to disentangle. That being said, given what I just said, I was quite pleased by the budget. I thought naturally it was very well delivered. Rishi Sunak, I think, is very impressive. But the thing I liked about it was the ambition. Clearly, this budget needed to try and have a quick win in terms of addressing the potential or expected fallout from the virus. But very importantly, it needed to have an ambition in terms of a longer-term agenda. Let me go through the different parts of the budget that I thought were important. When one judges any budget, not just today's, I think one needs to look at a number of features. Today had the additional feature in terms of the virus and how we responded to it, but not necessarily in order of importance. It was the overall narrative. What was the underlying message, the vision? What was the Chancellor trying to get across to us all? Second, then, how it dealt with the virus. Third, the economic numbers. Did they provide a sensible context? Fourth, the fiscal sums. Were they credible? Is the budget going to be tight enough to hold together? And then finally, the measures themselves. I thought the narrative was very good. As I mentioned, it was ambitious, but in many respects, it will be tied in to how you assess the response to the virus. Given what I said at the beginning of my talk about the lesson from overseas and also the lesson from previous crises, the Chancellor clearly was reflecting the fact that this could be a U or a V-shaped impact. Temporary. He talked about a timely, a temporary, and targeted response. Indeed, words I used when I spoke on Radio 4 the other week by chance. So I'm going to agree with the measures announced. He talked about a 7 billion boost in terms of to small firms, stability and safety, a 5 billion boost to the NHS, and on top of that, he said more would be necessary, available if necessary. Now, if a fifth of our workers in the country were out of work, as he said might be the possibility, in all likelihood, those figures might well have to be higher. But I would say that one has to congratulate the government, and indeed the opposition, I think, was very supportive of this as well. It wasn't a party political issue, but a sensible policy response. It's not going to be able to stop the crisis impacting us, but if it's executed in the way in which the Chancellor hopes it will be, then it will mitigate many of the worries. Then we come on to the economic numbers. Now, the challenge is that the independent OBR released its forecast was made a few weeks ago before the latest escalation of the crisis. But the growth figures, 1.1% this year, 1.8% next, 1.5, 1.3, 1.4. It still is consistent with a pretty low growth economy, but of course the virus will hit. But the Chancellor did point out, and I would agree, that these fiscal measures, if implemented, will have a significant impact on overall growth of 0.5%. Now, the challenge, of course, is where do you see trend growth? We have, in most forecasters' views, a very low level of trend growth. A low level of trend growth means the Treasury thinks there's less room for fiscal manoeuvre. But more importantly, maybe in terms of the interest rate picture, if we still have a low level of trend growth, then we might start to hit bottlenecks sooner than is expected. But nonetheless, the economic numbers reflect where we are, but also I think it's sensible to say the policy measures should help in terms of the growth picture in the near term, not just in terms of how it handles the crisis, but more particularly as the investment starts to take hold. I tend to say that we need to get all the I's right. And this budget, I think, implicitly was trying to do that. Infrastructure spending, encouraging more investment, encouraging more innovation. There was a big focus on science and R&D, and also getting the incentives right. But that's where the devil needs to be really focused on. The incentives is for firms to continue to employ people and to continue to invest, helped by the tax and regulatory environment. The fiscal numbers really are work in progress. This is the first of 3 big fiscal events this year. The comprehensive spending review is later this year, and then the second budget later this year. By then, naturally, we will have more information about the virus and hopefully past the worst, as the Chancellor and we all hopefully, or the Chancellor expects and we all hope for. He's keeping with the fiscal sums, but those fiscal numbers need to be reassessed. I personally am not a big fan of the fiscal rules. Clearly, we need to have a sensible fiscal policy, but when one looks at the past, all chancellors have had fiscal rules which they've either tried to work around, discard, or just get rid of. But we do need to accept that we have had a big fiscal boost today. I looked at one of the tables just before I came in here, and let me just, if you don't mind, I'm going to take 2 more minutes. The spending figures, these are quite considerable. Obviously, let's go for 2021. Spending of 19.3 billion, then 40.2 billion, 45.6 billion, 48.8 billion, then by 2004-5, 49.4 billion. So that's reflecting a £175 billion infrastructure boost over 5 years. What the Chancellor didn't mention in the budget is that he is raising taxes, albeit in comparison to the figures I've just mentioned, by only a small amount, by 1.4 billion in 2020 to 21, then 3.8 billion, 7.1 billion, 7.6 billion, 7.5 billion. If he's going to receive any criticism, maybe people might say, well, we should really be aiming for lower taxes. But if you stick to fiscal rules, if you spend that much, it doesn't allow you lots of room for manoeuvre on the tax side. And finally, in terms of the measures themselves, I'm sure you'll read this in detail tomorrow. What I would welcome is the focus on areas such as innovation and the focus on investment. It is an ambitious budget. I think it's a necessary focus, given where the economy has been. And I think one of our biggest challenges in the UK has been that our biggest export has been our pessimism. We are realistic about the challenges in the country. It is a very imbalanced economy. We're realistic about low productivity, and that means low trend growth. Therefore, I think it's welcome that we start to have an ambitious policy to try and raise that trend rate of growth. The challenge, as with other budgets, is that the measures themselves make sense in a circular type of way, provided they feed the economic growth that then delivers the fiscal numbers. If the growth underperforms, parts of the budget start to unwind. But we do have an opportunity later this year in the comprehensive spending review and the second budget to maybe bring it back online if necessary. So putting it all together, the virus, L, U or V, that's what the question in the markets is. Hopefully it will not be an L, a slump. Ideally it would be a V, of recovery quickly, more likely a U. Weakness in the first half of this year, stretching into Q3, and a technical global recession. Second, some of those longer-term global themes I've touched on. And third, the UK policy approach, leaving the EU, it's been done to make sure it ties in with our domestic agenda and the relationship with the rest of the world. And in terms of that domestic agenda, monetary and financial policy, the supply side agenda, and the fiscal boost. Thank you for your time.
Please sit down. Thank you very much, Gerard. So before we get to questions, do start thinking about your questions. We have got the mics roving around, so put your hand up and we'll get a mic to you. You can also obviously submit your question through the app. I've already had quite a few, but if you've got any other questions, then do. We've got time to ask a few questions. Before we get to questions, though, while you're formulating those, a quick update on the budget. So I had to leave at the point he was still spending money, and I think he'd got to 17's "we'll get this done." I don't know whether he did more "get this done" after I'd left. But he's promised a review into net pay RAS and RAS. He's going to have a call for evidence on pensions tax, so that's one thing. Secondly, tapered allowance. He's going to increase the tapered allowance so that it starts to kick in from 200k. That's quite a big step up. It's obviously to do with NHS consultants. But the quid pro quo for that is that the annual allowance after that is going to reduce from 10k for those individuals to 4k for those individuals. He's going to have consultation, I think, on RPI and CPIH, closes in April, and implementation from 2025-30. And the lifetime allowance is going to go up in line with CPI as it did last year. So there's a quick update on where we were with the budget. Okay, so I suppose first question I'll ask, 253 trillion dollars of debt worldwide.
Yeah.
I mean, on the scale of, at one end we've got Love Actually, and at the other end we've got a Will Smith disaster film.
Yeah.
Where are we and what's the trajectory?
Well, it's a very interesting debate. There was a big debate raging over the last year, even before the coronavirus. Japan at one extreme arguing that if rates of economic growth were in excess of rates and yields, then you can justify even more fiscal expenditure. And then you get into the debate about the role of the central bank and who holds the debt. In Japan, the central bank is holding more of the debt. So you can argue there that the net picture is different to the gross picture. Then in the States, we have modern monetary theory, which has some validity to it, but not. I'm not going to become an enthusiast about it, but the validity is that you take account of the changing current circumstances. But nonetheless, at the end of the day, you do need to have some fiscal credibility. And it really comes down to the ability to achieve growth. And of those three arrows I touched on, monetary policy, fiscal policy, supply side agenda, what we've seen, I would argue, globally in the last decade has been the focus on monetary policy. Now it seems that we're going to have the focus even more on fiscal policy, leverage building up, but it's that supply side agenda that becomes more important. So in answer to your question, we're in the current situation where, because of other issues, and low inflation, low rates, low yields, the debt picture becomes manageable, but that very easily can change. Bond yields at the moment, therefore, can still stay low, but there's no pricing of risk factored in, and at some stage yields do need to rise. Okay.
Is there anybody in the room who's got a question? Otherwise I'll move on to the other ones in the air. No, the lights are staying dimmed. Can't see any hands in the air. Okay. So it does lead on to the next question. So this morning we saw interest rate cut to 0.25%, 25 basis points. And of course, these are unprecedented circumstances, but that's ahead of actual Brexit.
Yeah.
What are the tools going to be available? What are the options available to the Bank of England next year after Brexit? Will we need them?
You see, part of the challenge, I would say, in terms of Brexit is the way the whole narrative has been set. The economics profession largely was very negative about Brexit. And the impression, if you were a non-economist, was that lots of different forecasts were coming up with this view. But in actual fact, most of the critics of Brexit were based on the same economic model. And it was a model that Treasury themselves used, and they've since discarded.
Okay.
And therefore, we're starting to see a slight change in the narrative. Of course, the reality is that you can't leave something you've been in for over 40 years easily. And for those firms who trade with the EU, they're not going to see it, in their view, being any easier. But 8% of firms trade directly with the EU, their supply chains will be bigger than that, so 13% of the economy. So in answer to your question, it comes back to what you do on those domestic levers. But in terms of interest rates, it's not just in terms of Brexit, but the UK is slightly in a better position than the European Central Bank. But we are in a situation where, because monetary policy has been the shock absorber for so long, focus is now going to be even more on other areas of policy, prudential regulatory policy, or fiscal policy, or supply side policy.
So you think the risk of negative interest rates is probably terribly real?
Here in the UK, I would not advocate negative interest rates. At one stage, it was possible that we might see the bank, if it wanted to be adventurous, go in the path of Japan and fix long-term rates. But as you probably saw last autumn, the central bank governor in Japan, Mr. Kuroda, having been a keen advocate of the Bank of Japan keeping the yield curve flat at zero, then started to express worries about life insurers and pension funds. So you need to be mindful of the need to have an upward sloping yield curve at some stage.
Okay. So we've got one there. We'll take one from the auditorium at least. So keep your hand up. If you could tell us who you are as well, please, that would be great. Thank you.
Leslie Galanders, AIB Pensions. If you look back at the financial crisis in 2007 and 2008, when interest rates was probably 5 and 6%, and then I suppose the interest rates started to fall to help, I suppose, the economy. We're now sitting with 0.25% interest rate. What can we do? Where I suppose we can't really go much lower than that.
Yeah, I would answer the question in relation to same answer in relation to monetary policy and fiscal policy. I think the challenge, not just for Britain, but quite frankly for most Western economies, is that in the good times, we have not put rates high enough, and in the good times, we have not run budget surpluses. Often, when you start with rates being low or the budget in deficit, when you come to a downturn, because we might not be in the initial best position at the beginning of that downturn, there's a tendency to think, should rates go any lower or should the budget deficit go any higher? Indeed, you could say that's an issue at the moment. But I think two wrongs don't make a right in that respect. You can't respond to your initial starting position by not easing policy further, because you have to address the challenge in front of you. But the real lesson will be that once we start to get growth momentum in this economy, then we need to start moving interest rates back to some neutral level, or natural level, whatever one might call it. At Jackson Hole last August, where central bankers meet, the focus was on R star, where's the natural level of interest rates, and it's becoming more globalized. Global influences and that natural level of rates is starting to converge across the globe. So the lesson really is in good times to push rates higher and also to tighten fiscal policy or to see revenues grow in good times. The UK has only run, I think, budget surpluses for 6 years since 1970. So I hope that answers your question. Obviously, if we sit here at the moment, 0.75 down to 0.25, it's interesting. If you were a first-time buyer and went into your local branch now, they would stress test you on whether you're able to borrow probably at 6.5% because of the macroprudential measures. That's where the changes sometimes need to be. Okay. You need to actually make sure that if its rates going down. One of the senior people at the Bank of England was telling me he went in to give a talk on interest rates to a school or college, and someone in the audience said, but those rates don't mean anything to us. We have to go to a payday lender. But I think in terms of macro policy, it's tying it in or other areas. But the challenge, of course, is that the starting position often should be higher. And so I would support the rate cut we've had this morning. I think rates need to stay low, need to rise gradually when it's sensible to do so. But ideally, we need to get them back to a higher level so that in future, that starts to send the right signals and right messages. Unfortunately, I think we're still some way from that, given the macroeconomic picture.
What did the central bankers conclude was our natural rate of interest?
It was going down. That's what they concluded. Okay. Well, it had gone down was the answer to the question.
They didn't give us a number, though.
No, you
going down, so we might converge eventually.
Well, actually, no time's time. But today in the budget, answering it this way, one of the key fiscal measures, and this will be interesting to note after the fiscal review, one of the key fiscal measures that the Chancellor alluded to in his speech today was debt to GDP. Still high, highest in peacetime, or was the highest in peacetime recently, but trending down. I think I would personally like to see a review of the Bank of England's mandate, partly because conditions have changed. There is some sort of review underway, but maybe it's not as deep-rooted as the review in the States and in the ECB at the moment. But maybe a move to a nominal GDP target might make sense, because that's relevant for your question. If you then factor in a 2% inflation and maybe 2% growth rate, then 4% nominal GDP, then you can start to make inroads in your debt to GDP figure. And then you can start to move away from a situation that you currently have almost of financial repression with very low rates and start to allow interest rates to trend higher. But again, it's about tying it in and maybe being patient. Unfortunately, I think we're, for whatever reasons, tied to relatively rates for some time at the moment.
Okay. So we are unbelievably out of time already. We're going to go into an extended break so that you can discuss the budget at length. Now, don't forget to rate the conference on the app and rate both the sessions that we've had so far. Thank you very much for attending. We're going to go out to that extended break, or we're going to come back here for 4 o'clock. Don't forget to tweet as well at PLSA Invest 20. PLSA Invest 20. Just one last observation, really. You said that, and this is maybe a solution, you said that pessimism was one of our major import or exports. I just wonder whether we could apply a duty to it.
Yes, that's right.
Okay.
Maybe.
So we'll see you after tea. Thank you very much, everyone. Thank you very much.